at regular intervals of time, a predefined fixed amount is typically paid. In general, it is fixed, though there could be a variation, and there is a principal repayment on a maturity date. A maturity date also is known in advance, and that is the principal is repaid on that particular maturity date. That's a broad characteristic of a bond, and we see that some of these bonds are tradable in the market. And what we typically see is, depending on how the interest rates in the market are changing, the tradable values of this particular bond also change accordingly. And generally, the different kinds of bonds, they are associated with different credit ratings. So what we typically are talking of is, every bond has a unique set of characteristics, whether it is with respect to the way they are doing the payments, whether it is with respect to the credit ratings associated, and the kind of tradability that is associated. We can talk about wide varieties of features that are typically associated with a bond. While in simplistic sense, a bond is an instrument which typically makes a series of interest payments at regular intervals of time, and a principal repayment on maturity. What we see is lots of variants can come into it, and that is what we spend time now in terms of understanding what this fixed income security is all about. What are the key differentiators or key features that are associated with this fixed income security, right? So a few things to focus on. First, we will look at who has issued the bond. Typically, the issuer of the bond. In general case, the issuer of the bond is that particular entity who is borrowing, right? The borrower, the issuer. Otherwise, from a bond terminology, whatever is called as an issuer, in reality is actually doing the borrowing money. So it could be done either by the various corporations, the companies, both financial as well as non-financial kind of companies can get into this borrowing part. Or in some cases, we see that the governments get into the borrowing. Again, within that government, we can talk about the national government doing the borrowing, or it could be the state kind of governments which could do the borrowing, or in some cases municipalities can do a borrowing for various social welfare activities, or any other quasi government bodies, right? Some government agencies where government is not having a direct obligation to repay. Whereas in all these things, okay, here the national government is obligated to pay. Typically, we call them as sovereign bonds. Here, the state government is having an obligation to pay. Here, the municipality government is having an obligation to pay. But here, it's a government entity or quasi-government, semi-government kind of a body will issue the bond. So, government does not have a direct obligation with respect to the payment. So these kind of things could be there, but there could be a few borrowings which are supranational entities, which is much beyond the government. Probably those kind of organizations which are operating in multiple countries, multinational kind of setups, and generally we categorize IMF, World Bank, these kind of entities under the supranational kind of entities. So even they can get into the borrowing. So what we typically see is different issuers can operate in the bond market, right from the corporations which want to borrow money for executing their business, to governments which want money for implementing various welfare activities, to the supranational entities like IMFs and World Banks borrowing again for the implementation of their different projects. So every bond is characterized first by the issuer. Then another differentiator with respect to the bonds is the maturity. So in some cases we can have a maturity of 1 day, right? This is the date on which the principal repayment will happen. Remember that whenever I am talking about the maturity period, we can interpret it as the date on which the principal repayment happens. And what we can look at is it could be anywhere like 1 day, or even it can go up to 30 years. So there are different maturities that are present. And as a word, the maturity, we also hear the words like term to maturity or time to maturity, or we even talk about the word tenure of the bond. So the bond is still the bond is going to mature in this many years of time. So there are bonds with very, very low maturity periods, and there are bonds with very high maturity periods. Of course, there are a few bonds even which are issued for 100 years as well. And in some cases, there is no maturity date also. And wherever there is no maturity date, we call those kind of bonds as perpetual bonds. And what we see for those perpetual bonds is only the interest keeps getting paid at regular intervals, but there is no commitment on the principal repayment date. And as a classification, any kind of maturity which is less than 1 year, we call those kind of bonds or securities as money market securities. But wherever we see that the maturity period is greater than 1 year, I will classify them as the capital market securities. So that's one more important dimension and classification that is associated with the maturity of the bond. Then another dimension or another important term that we need to be comfortable with is the par value. Sometimes we call it as face value, or sometimes we call it as the principal amount to be repaid, or sometimes it's even called as maturity value, right? On maturity, what is the amount that is getting paid, or even redemption value. When the bond is getting redeemed, what is the amount that is typically getting paid? But all these mean the same. What is that particular amount that really gets paid when the bond is matured? On the date of the maturity, what is the amount that is typically getting paid? That is what is called as a par value. And what is very much important for us regarding the par value is any kind of a price at which I have to purchase the bond today, right? At which I want to purchase or sell the bond, it is always expressed as percentage of the par value. So if the par value is 1000, and let's say currently the bond is being sold at 1020, the way it is quoted in the market is it talks about 102. It is quoted as a percentage of the par value. So a percentage of the par value, typically 1020 divided by the par value of 1000, if I am expressing it in terms of percentage, it comes out as 102%. So any kind of price quotation regarding the bond is established as a percentage of par value. And what we typically see is any bond in the market, if it is being sold for more than the par value like this, greater than the par value if it is being sold, we call those kind of bonds as the bonds that are sold at a premium. If they are less than the par value, if they are sold at less than the par value, we say that these particular bonds are being sold at a discount. Otherwise, we say that they are being sold at par. So the par value is helpful from that particular perspective as well. It really is associated more and more with the pricing. Every bond that is being sold in the market, it is priced either at a premium or a discount or at the par value itself. Whereas the other dimension also where the par value helps is the coupons. Coupon typically as a definition is that particular amount that is paid on a regular basis. Whatever is that particular amount that is made as a series of regular payments to the investors, that is what we call as a coupon. And there is a coupon rate that is associated. Even that rate is established as the percentage of the par value itself, right? And that particular coupon is typically paid. If I say the coupon is 8% and par value is 1000, it means that 80 dollars is typically being paid every year as a part of the regular payment. And if the bond is having a maturity period of 5 years, it means every year there is 80 that is getting paid, 8% of the par value, $80 that is getting paid every year until 5 years. So that is how the coupon gets linked. Even that is expressed as a percentage of the par value. And these coupons generally there could be paid on an annual basis or probably any other frequency. It could be paid on a semi-annual basis. Now if they are paid on a semi-annual, the same coupon would be paid as 40 and 40. 40 would be paid now after 6 months and the remaining 40 after 1 year. The same way we can talk about quarterly, which means in 4 quarters 2020 is being paid. So expression wise, the coupon is always expressed in as a percentage of the par value, and that too the annual payment that would be paid. But the frequency of it decides at what time period how much is typically being paid. So coupons is one more important aspect with respect to the bond. And if this coupon is generally fixed, right, if it doesn't change every year and it is fixed, we call those kind of bonds generally as conventional bonds, or sometimes people call them as plain vanilla bonds. So that's one more important concept that needs to be comfortable with. And some bonds, again the difference is some bonds keep paying a regular coupon like this, whereas some bonds say there is no coupon payment at all. Only the par value is paid on maturity. No intermediate payments until the maturity. So if I am talking about a 5-year maturity period, there is nothing that is paid at the end of 1 year, 2 years, 3 years, 4 years. Only the par value is being paid at the end of 5 years. Those kind of bonds which don't pay any kind of coupons, any kind of regular annual payment, they are classified as zero coupon bonds. The word as it is clear, they don't pay any coupon, and that's where they are called as zero coupon bonds. And and if they are not paying anything in the middle, obviously the price at which they have to be sold is much less than the par value, right? Because the par value, let's say, is 1000, they have to be sold at much lesser than 1000 today because they don't make any intermediate payment. So we'll say that those kind of bonds are always being sold at a discount. And we also use the word they are pure discounted bond because at any cost they are needed to be sold at a discount itself. They can't be sold at a premium at all because they are not paying any intermediate payments. Later we'll try to see if a bond that is paying the intermediate payments, depending on how much it is paying in the middle, it would be either sold at a discount to the par value or at a premium to the par value. So this is one more